you have to look at the three ways in. So when you're thinking about a qualified opportunity zone investment, there's three ways that you can do it. You can do what's called a direct investment. You can do or join what's called a single purpose entity, or you can be a limited partner inside of a qualified opportunity zone fund. Now let's look at the pros and cons of each of those. On the direct side, this is really for those who already have a steep background, maybe even some infrastructure, meaning project management, diligence teams, analysts, and an experience developing and researching real estate investments in a specific market. And typically what it means when you do a direct investment is that you're going to commit somewhere in the neighborhood of $5 million more into a single project. Main reason being that most of these projects that are being developed are everything from multifamily housing to mixed use places to even boutique hotels or things like that. And so these are not cheap things to build. These are not just doing a little flip my house. This is literally entering a known market where you have experience and where you're writing a significant check. Cons to doing a direct investment are you're limited from a diversification standpoint, meaning all of your eggs are in one basket. The capital entry is typically going to be pretty high. Your experience level is going to matter a lot, which we'll speak about in a second. And market risk is higher because in a downturn, which we are due to have any time now, since we've had 12 years of up and to the right economic growth, which is the longest period of time that we've had such a run without a recession, you have to evaluate over this 10-year horizon what the potential market risk is of having all of your eggs in one basket in a geolocation. But for those of you who feel qualified to do that, a direct investment opportunity might be right for you. Another version of that gives you a little bit more diversification and has a little bit more help and a cheaper way in is what's called a single purpose entity or an SPE. Now, the pros of an SPE are typically there's a real estate fund manager and they are helping perform the diligence. They are helping to manage the investment itself, but this would be similar to a direct investment. The difference being they allow for fractional ownership. So let's take that $1 million gain again from the earlier example, and let's say that you were looking at an SPE because you like a specific region, or maybe you even like one or two regions, but you're not interested in a fund. Maybe you have enough investment experience in the real estate development market or VC market or combo thereof. Maybe you feel like you have enough staff on board that's full-time able to project manage and help you analyze these things. And what you want to do is you want a limited amount of exposure into certain markets. So you could write checks typically anywhere from $100,000, maybe even as low as $50K into one or multiple SPEs. So if you took the $1 million example and you rolled that over into qualified opportunities on investments, you could find anywhere from 10 to 20 SPEs, and you could enter those as a fractional ownership part of that. Now, sometimes SPEs are formed by the person who is doing a direct investment into a property in a specific location. What are the cons? The cons are they're focused in one investment. So unless you're in multiple SPEs, you still have the same market risk and exposure in a downturn or something similar as you do in a direct investment. There are slightly higher costs potentially than the direct investment because you're paying lawyers to review multiple documents and maybe even set up different entities for each. So things to consider there. The most popular version of what you will see most accredited investors join will be something like a qualified opportunity zone fund. Now, there will be high volume, kind of large multi-billion-dollar funds, and then there'll be smaller ones and everything in between. Now, the reason why opportunity zone funds are interesting and the pros are you're nationally or regional, but most of them are national, meaning your exposure risk is going to be across deals across this country and not just in one geo target. They're most likely to be the most common form that accredited investors invest in. And so there'll be a lot of competition potentially, but also there'll be some of your best experienced professional managers will start their own fund because of the opportunity that it represents for them, given their breadth of experience in prior and the market opportunity. Now, why this, in my opinion, this is my opinion, why I think funds will dominate the landscape personally is also because if you think about what kind of capital gain is being used, the incentive is for capital gains that did not come from a real estate asset sale. And so things that do not qualify for a 1031 exchange, Why I bring that up is because the investor that typically does 1031 exchanges has the experience required for direct and SPE type investments. The investor who made their money selling a business or trading a stock or investing in crypto may or may not have the staff, have the experience, or be qualified or even interested, therefore, in doing the things to analyze a good investment that is heavy on development and real estate as well as business. They just may not have that skill set. So again, funds will fit a need in the market based on the capital source that is being incentivized to come into these things and that is ultimately allowing you to defer those capital gain taxes. So these are great for, funds are great for high net worth individuals and family offices. So think accredited investors and family offices. Third party will handle all the aspects of diligence, project reporting, accounting reporting. Essentially, you have a professional team that is only worrying about how to maximize ROI and mitigate risk. And so anyway, let's talk about the cons. Less likely to have visibility into each portfolio asset. So in an SPE, in a direct investment, you're going to see a bunch of materials with pro formas and NOI and net operating income projections and cap rates and everything on specific deals because you know it's going into one deal or you're a fractional owner in one deal. With a fund, you may or may not understand at any given time and have direct visibility other than your quarterly or annual reports that you get from your fund manager into what assets that fund holds. Now, for some of you, you will not care. What you'll care about is, does the management team have a prior track record of success, getting nice or abnormally alpha returns to market on money? Because that's the game you're playing here, is compounding your wealth with money that you can have full access to for a period of 7 years. And that money, if you leave in the gains for a period of 10 years, will be exempt from any future capital gains tax on that appreciation. So ROI is going to be key, in which case a fund manager, again, is probably a good fit. Now, the knock you'll hear on YouTube and other places from people that are saying why funds aren't good is related to fees. And so fees can be an issue for people that maybe feel like they have a lot of experience in this or have overhead. We'll talk about fees here, an example, because a question came in. But those are the cons, and they, and it's important